You open the app and you want to buy 10 shares of Apple. You tap buy and a confetti animation explodes across your screen. And there was no fee, no commission, nothing at all. It feels free. And that's the problem. Nothing in finance is free. Free is just a price tag written in a language you haven't learned to read yet. So here's a question worth roughly $9 billion a year. If you didn't pay for that trade, who did? For most of stock market history, buying a share cost money. A broker placed your order. The broker charged you a commission. Everyone understood the arrangement. You paid, you got a stock, and the broker got a sandwich. Then a company called Robinhood showed up and said, what if it costs zero? After that, everybody else fell in line and cut theirs down to zero too. The idea of we'll do this complicated thing for you forever for free is the kind of sentence that should make a reasonable person nervous. Because free isn't a price. Free is a strategy. When the product is free, there's an excellent chance that the product is you. To understand how you became the order flow, we have to follow your 10 shares of Apple on the strangest 1-second journey in modern finance. Stage 1. You tap buy on the app. The order arrives at your broker. We'll use Robinhood as an example. First surprise. Robinhood doesn't go and buy the stock for you. Robinhood is a storefront, not a trading floor. It's like a travel agent that books your flight but has never once set foot in an airport. It takes your order and hands it off to someone else. Which brings us to stage 2 and the entire point of this video. Your order gets routed to a wholesaler, also called a market maker. And the wholesaler does something that, the first time you hear it, sounds backwards. The wholesaler pays Robinhood to receive your order. Read that again. The middleman pays for the privilege of handling your trade. And that payment has a name. Payment for order flow. We'll abbreviate it PFOF. Stage 3. The wholesaler fills your order out of its own inventory, a practice called internalization, which sounds like something a therapist tells you to do, but here it just means the wholesaler skips the exchange entirely and fills your trade itself, in-house, right then and there. It doesn't shop around the New York Stock Exchange for 10 shares. It already has 10 shares sitting on its own books. It sells them straight to you at a price slightly better than whatever's available on the public market. That slightly better price is called price improvement. And it's actually important, but we'll come back to it later. Stage 4. The part nobody sees. Your trade drops into a clearinghouse called the NSCC, the National Securities Clearing Corporation, which nets it against millions of other trades happening that day. Then, one business day later, ownership and cash actually change hands at a depository called the DTC, the Depository Trust Company. You never get a paper certificate. You never physically hold the share. A nominee holds it on your behalf in what the industry calls, without irony, street name. You own a database entry pointing at another database entry. Congratulations, you're an investor. Before we talk about who's getting rich, let's make sure we understand the mechanics, because most of what gets written about this is, and this is a technical term, wrong. Imagine a stock is sitting at $10 to buy and $10.20 to sell. That 20-cent gap is called the spread. And the best available buy price and best available sell price, aggregated across every public exchange in the country, has a name. The National Best Bid and Offer. The NBBO. It's the official scoreboard. The publicly visible price that every broker is legally required to at least match for your order. Quick note on what your order means here. When you tap buy without setting a price, you're sending what's called a market order. An instruction that says, get me in right now at the best price available. In other words, you're telling the market, I'll take whatever the going rate is, just fill me immediately. Okay, back to the show. The wholesaler looks at the NBBO and says, I can beat that for every market order. If a person wants to market order and buy a share, I'll sell it to them for $10.15, 5 cents cheaper than the NBBO. If a person wants to market order and sell a share, I'll buy it from them for $10.05, 5 cents more than the NBBO. Both sides beat the official best price, and I pocket the 10 cents left in the middle. That's internalization. Skip the exchange. Deal directly. Everybody gets a slightly better price, and the wholesaler keeps the gap in between. Now, there's an obvious question. When you tap buy, your order fills instantly. How does the wholesaler find a buyer and a seller at the same time? The trading day has 6.5 hours. That's a lot of milliseconds. And people aren't trading the exact same shares at the exact same amounts at the exact same time. So the wholesaler does something clever. It uses its own balance sheet as a bridge across time. Imagine a sell order comes in. The wholesaler buys those shares and holds them in inventory. Kind of like how a pawn shop will take in your guitar on Tuesday, knowing full well that someone will want a guitar by Friday. Then a buy order arrives. The wholesaler sells those shares and earns its spread. The buyer and seller never even knew the other existed. This works because retail traders are, and I say this with affection, random. You buy Apple because you saw a headline. Your neighbor sells Apple because they need to pay rent. Neither of you has insider information. Neither of you is particularly likely to be right about where the stock goes next. You are small, dispersed, and, in the eyes of Wall Street, beautifully uninformed. That is the wholesaler's favorite kind of customer. Because the nightmare scenario for a market maker is called adverse selection. It's when the person on the other side of your trade actually knows something you don't. Imagine a giant hedge fund buying a stock because it just read an SEC filing that nobody else has fully processed yet. The fund knows the stock is going up. The wholesaler doesn't. The wholesaler sells, the stock goes up, and the wholesaler loses money. That's the risk of trading with informed people. They eat your lunch, take your car keys, and send you a polite thank you note. Retail traders don't do this. You're not front-running anyone. You're not armed with proprietary research. You just saw a ticker go up on your phone and felt something. And because your trades are random, the wholesaler can model them almost like matched pairs. Remember, for every person buying for no particular reason, there's probably someone selling for no particular reason, somewhere across the trading day. The wholesaler just bridges the gap, clips the spread, and repeats this a few billion times a year. That predictability is exactly why the wholesaler is willing to pay Robinhood for the right to handle your order. Now, a quick detour because there's a story about payment for order flow that you'll hear constantly, on podcasts and comment sections, and in congressional hearings. Robinhood sells your order to Citadel. Citadel front runs it, and you get a worse price. You're being robbed. This story is wrong. And not in a complicated, well, it depends kind of way. In a, you'd have to lose money on purpose to pull it off kind of way. Front running means you see someone's order coming, you jump in front of it on the exchange, you buy the stock first at the cheap price, and then you sell it back to them at a higher price, pocketing the difference. For that to work on your trade, Citadel would need to buy the stock on the exchange at 10.20 and then sell it to you at a profit. But Citadel's already selling to you at 10.15. That's less than 10.20. There's no profit in that direction. Citadel would be buying high and selling low, trying to front run you. That's not front running. That's charity. Second problem. Front running is illegal and the SEC does keep an eye on this. The real story is less sinister and somehow stranger. The wholesaler isn't stealing from your trade. It's making money from the gap between the public exchange price and the tighter price it can offer through internalization. It passes some of that gap back to you as price improvement, keeps a slice for itself, and writes a check to your broker for sending the business. Now you might be wondering, who are the companies behind all this? 6 firms handle more than 90% of all retail stock orders in the United States. Citadel Securities, Virtu Financial, G1X Execution Services, which is just Susquehanna wearing a trench coat. Jane Street, 2 Sigma Securities, Wolverine Securities. And in options, add Hudson River Trading and IMC. That's the whole table. And the giant is Citadel Securities. Across the entire U.S. equity market, it handles around a quarter of all retail and institutional volume. For solely retail volume, that number reaches 35%. In 2025, Citadel Securities made a record $12.2 billion in net trading revenue, a 25% increase over the $9.7 billion from the year before. Now remember payment for order flow? The check the wholesaler sends the broker? Here's where it happens. In 2025, brokerages collectively pocketed about $4.4 billion in payment for order flow. Robinhood itself made $2.6 billion. This was mostly driven by a mind-boggling 667% increase in cryptocurrency's order flow revenue in just the last 2 years. Technically, crypto isn't an SEC-regulated security, so these revenues aren't legally classified as payment for order flow, but functionally they're still the same. So this previous number here didn't include any crypto order flow revenues. And if you thought they were milking you for every last drop in stocks, just wait till you try crypto. For every $100 of stock you trade, a wholesaler pockets less than 1 cent, about 8/10. Trade $100 of crypto, though, and they're making 35 cents. And that's the conservative number. Robinhood's own disclosure says it keeps 95 cents for every $100 of crypto you trade through its default routing. Run the math, and your crypto trade is worth about 45 times more to them than the same dollar in stocks. Why? Same reason as always. Crypto traders are even more uninformed than stock traders, and the spreads are even wider. So here's the full summary. You order on Robinhood. Robinhood gives you free trades. Robinhood hands Citadel your order. Citadel gives you some price improvement. Citadel earns the spread, and Citadel uses some of that money to pay Robinhood. The fraction of a cent between the price you got and the price you could have gotten keeps everyone in the circle smiling. So the next time you tap that green button and it says free, remember, it was never free. Free is a strategy, and on this table, the house doesn't gamble. The house gets paid to deal.